Hi, I'm Morgan Smith, and welcome to WorthPointe Trending, a panel discussion on safety and opportunity, investing in the COVID-19 era, with our special guest, Apollo Lupescu, PhD and Vice President at Dimensional Fund Advisors. And the disclaimer, investors cannot invest directly in indexes, and they do not reflect fees or expenses of investments. Historical performance is not a guarantee of future results. WorthPointe is a fee-only registered investment advisor serving families and business owners across the United States with financial planning and wealth management. All of our advisors are designated as certified financial planning professionals and are also partners of the firm, so we are committed to taking the journey with our clients. Through conversations with our clients and partners, and given the current uncertainties associated with the COVID-19 crisis, we will continue to find ways to provide useful insights and thought leaders to help us all better navigate the coming weeks, months, and years ahead. In this panel discussion, you will hear unique insights into three distinct areas that we feel might be important for you: the macro big picture, safety, opportunities. And without further ado, I'd like to introduce you to our special guest, Apollo Lupescu, and he's responsible for communicating Dimensional Fund Advisors' academic foundations and investment beliefs. He presents an alternative to the traditional Wall Street approach. Apollo frequently speaks at various industry conferences around the country, as well as advisor-client events. Prior to joining Dimensional, Apollo served in a variety of roles with the U.S. Department of State, from which he formed his own consulting firm, Apollo Consulting Group. His interests in finance and investments led him to teaching engagements at the University of California, Santa Barbara. Apollo received his PhD in economics and finance from UCSB and a BA from Michigan State, where he competed and coached in water polo. Apollo, there you are. Good morning. How are you?
Morgan, how are you? Thank you
I'm
so much
doing
for the
well.
invitation to be here.
Well, I'll tell you what, it's
Virtually
a
here.
yeah, it's a pleasure to have you here. Obviously, the whole economic crisis with the coronavirus is providing us and our clients with a lot of concerns and questions, and we really appreciate you being here. And it's great to do this virtually.
Yep. Oh, and stay safe. I'm actually really glad that you're doing this because it is such an important topic right now, not on just the safety, but also touch on the opportunities. So I actually really enjoyed the way you framed it.
Very good. And just give me a little insight. You normally travel across the country and speak with a lot of clients and things like that. I assume you really get a good temperature read on what's going on
Yeah.
in the economy and in general.
Yes, I've actually had the privilege and the good fortune to work with so many individual investors through financial advisors, and over the years get a sense of not only how investing is being seen, how it's evolved, how investor attitudes have changed, but also as you move from period to period, we had the expansion. And there was a certain sentiment that investors had, and how it's changed now. And it's fascinating to see that from a behavioral perspective as well as the more analytical part of investing.
Well, good. I'm really looking forward to getting your insights here. And with that, how about we just dive into it here? The first area that we wanted to cover was kind of the macro big picture.
Mhm.
So let's discuss some issues as they relate to the big picture. I think my first question is, it's really hard to sync up our emotions during periods of extreme uncertainty with the reality of investing our hard-earned savings in the markets. And, quite frankly, it can get kind of confusing and exhausting for a lot of folks out there. We read and hear news and often expect the markets to react in a certain way, but often the markets react differently than what we thought. So I wanted to explore, why is that? Is it because maybe we missed something? Do investors' own biases filter what they wanted them to hear, or is it something different?
Yeah, no, that's a great place to start because I do feel that that's one of the questions that comes up most often, and you put it just right. Right now, at least where we stand today in early May, there seems to be a disconnect between what we hear on the news with 30 million people unemployed. We have the economy shut down, all these bad news. So when you open the papers and you read all these bad news about the economy, it just sounds really dark and bleak. And you turn to the investing section, and what you find is that the market has had a pretty remarkable bounce back after the lows from about a month and a half ago. So why is it that the economy is doing so badly, but somehow the market has staged this comeback? Is it because that maybe the worst is yet to come and we just haven't figured it out yet? And are we in for more pain when it comes to our hurt earned savings? So let me start with that question because I think it's very important. We're talking about things that are related. When you're talking about the economy and the market, they both have to do with businesses. And there's no doubt about it that there's a relation there because it's all about business. How is business? And when you look at the economy, you see, well, the business not doing that well right now. And when you look at the market, you look at the same business and you're thinking, well, why is it doing so much better on this side of the market, but not on the economic side? And to really understand why is because when you look at the economy today, it is a snapshot of what is going on at the current time today, May 2020. What is going on today in the economy? That is the snapshot. That is one frame. What the stock market is something very different. It is not just how the businesses are doing today, but the stock market allows investors, people like you and I, to have a stake in capitalism in a way because it allows us to buy ownership into these companies. So the stock market is tied to the ownership of these businesses. And the reason it's so different is because when I look at owning a business and I buy a share of any company out there that's traded on the market, what I'm really buying are payments that I expect to receive for years and years and years to go. So the difference, the fundamental difference is that the economy is about now and maybe what's happened in the past, whereas the stock market is about now and the future. It's a very forward-looking machine that is trying to figure out how much should you pay today to receive profits from these companies. That's the fundamental premise of the market. You're buying ownership in companies, and when you have an ownership into a company, you are entitled to part of the profits that the company will make, proportional to how much you own. So the stock market is not looking at what's going on right now. It's trying to figure out what will the profits of these companies be for years and years and years and years to go. So even though the situation might be bleak right now, what you're trying to see is what will those profits be 6 months, 1 year, 3 years, 5 years? And I have to tell you, Morgan, it is a very long-term proposition. You might not own a stock for 100 years, but the reality is that the price that you pay today reflects the fact that you expect to get paid for 100 years. And it's not unreasonable to say, well, how many companies have paid for 100 years? I'll give you some examples. So you have Exxon, you have Black and Decker, you have Eli Lilly, you have Con Edison. There are so many companies that have been paying investors for over 100 years. And that's basically what you're buying today in the stock market is future profits. And in that respect, if you look at the next 6 months, 9 months, a year, how much does it matter when you have payments coming for the next 50 or 100 years? So that's why there's such a disconnect because the economy is about now, whereas the stock market, it's a very forward-looking pricing machine that's trying to figure out how much is this business worth in terms of all the payments that it will generate to shareholders.
It's so first off, that's a great explanation because I think what happens is a lot of times people get focused on today and they forget about the future. And as you're talking about the future returns of these companies, really in my mind, working with clients and all of us here, we really think about projecting forward on the future income created by a portfolio, not just today, but 10, 20, 30 years from now. So that is interesting. So I guess to summarize your point, it's you really can't look at the economic data out there to determine why, what, when, how, and why the market's going to react the way it reacts.
Yeah, so let me try to kind of there are two analogies that might help your listeners. The first one is, think of the economy as being somebody walking a dog. And the market is being the dog, and it's a hype dog. And what I mean by that, they're both going in the same direction. But while the economy tends to go pretty steady, sometimes they go faster, sometimes slower. But it goes. The dog might be all over the place, and they're not the same thing. They're related. But I think, to me, my favorite way to kind of visualize this, to visualize the difference between the market and the economy, is think that what's going on right now in the market. It's basically a snapshot. It's a frame, and it's a single moment. But what really is important is that this frame, this scene, is part of a much larger movie. So what you need to do is play the entire movie. You can't get stuck at the first frame or one of the frames in the movie, because there are thousands of these scenes that will play out over the course of owning a stock. And that's the difference. Today is a snapshot. It's a frame. That's the economy. This owning a stock. It's a very long duration movie. And this it is actually a very long duration movie, because when I was telling you about 100 years, I wasn't kidding. All these are companies that have been actually paying shareholders for at least 100 years, and we recognize in all of these. And to really get a sense of that, the one that has been paying investors the longest in the U.S. Economy happens to be the York Water Company out of Pennsylvania. And it was about 40 years or so after when we went through the war with the British and we became independent. That's when they started to pay shareholders. And ever since, if you own a piece of this company, you would have gotten paid as a shareholder. That's what I'm talking about. It's a very, very long-term proposition. It is not based on what happens today. So you have to put some perspective. You have to play the movie all the way through.
Well, I got to tell you, I've never heard the walking the dog analogy, and I love that, having been a dog owner and getting yanked around by my dog, putting off saying that the stock market's kind of like the dog, and you're the economy. That's great. I love that. So I'll put that in my back pocket and use it someday, if you don't mind.
Please.
Very good. Well, let's move on to the next question. The research by Eugene Fama and Kenneth French uncovered the value premium in 1992, and Rolf Bantz from the University of Chicago first published his findings on the small cap premium in 1981. So these are factors and premiums that we like to tilt towards. For clients and perhaps advisors alike, it might be frustrating for those who have invested with small and value tilts when those premiums don't reveal themselves for significant periods of time. What are your thoughts on this? Should we give up on the premiums? And how do we address this, both as end investors and as people who are giving advice and saying, look, here's the research. It's peer reviewed and it's based on decades of good data. What are your thoughts on how to approach this conundrum, if you'd call it?
Yeah. No, it's and to begin with, it's so interesting, because the research that started back in the 70s and 80s, over time, people have looked at it and in a way try to challenge it, either by looking at different time periods or looking at international markets. And over, what you saw is that the more people looked at it, the more the data actually backed it up. So the industry as a whole has moved in that direction. But what I like to start with actually is something a little bit different, which is asking the question, why? Why should I expect this to begin with? So you mentioned these two, what we call premiums, and they're sort of dimensions in the market. And what do we mean by that? Well, if you think of the stock market, and I'll just use this square to represent the entire stock market. All the stocks fit in this box. one of the challenges that investors have had, and academics for the very long time, was to be able to distinguish between different groups of stocks, because we all know intuitively that not all stocks are the same. There has to be a delineation, a way to separate and say, well, this group ought to behave differently than another group. And up until the late 70s, people looked at sectors and they were saying, well, pharmaceutical, transportation, technology. And when they looked at it, there's some problems there. The first one is that there was no good economic theory why one sector should deliver higher or lower returns to an investor. The second one is that it's not easy to categorize a company into a particular sector. And today, if you look at Facebook or Google, they're considered to be technology companies. And yet, when you think about it, what they're selling is advertising and media. They're competing with Disney and Viacom. So to me, the big breakthrough came in the 1970s and the late 70s when an academic actually looked at economic theory as well as data. And you mentioned his name, Ralph Bonds, and he was at Chicago at the time. So what he did, he basically suggested this, that when you look at the U.S. market, there has to be a distinction between large companies in the market, and these are the well-established, mature, grown-up companies, the blue chips, the Jumbotron, well-known, Apple, McDonald's, Google, Coke, Johnson & Johnson, all these big companies, Chase Bank. And that's what you typically see in the S&P 500, which is a broad measure, not of any one of these large companies, but the 500 largest companies in the US. There are about 2,000 other companies in the US market: New York Times, Bank of Hawaii, GNC Nutrition, Columbia Sportswear, you name it, Buffalo Chicken Wings. And all these companies are not part of the S&P, but they do trade on US markets, and they're called small caps or small company stocks. And intuitively, what Ralph Bonds had kind of defined back then was that if you look at an investing money, there has to be a relationship between the uncertainty of a company and what you get paid as an investor, because you are deploying capital. So if you have a McDonald's and you have, let's say, Shake Shack, which is another burger joint that trades on the market, McDonald's is a much more mature, well-established company, whereas Shake Shack is still a large company relative to other burger restaurants, but they're not nearly as much as big as McDonald's. So if you think about it, if I have a choice and my money grows at the same rate between McDonald's and Shake Shack, it seems I would have more mature. The more mature company would give me more certainty, because they have a track record. They've been through things. So if the payout is the same between small and large, I'm just going to go with the large. Why bother with the small ones? So the small ones do have to give investors a bit of a kicker. They also have more room to grow. I can see Shake Shack maybe doubling a little bit easier than McDonald's. So
Right.
to see this at play, probably the best thing is to look at the Matrix book. And I know we're virtual. I know you have a book there like that, and it shows you probably in the easiest to understand terms how to think about the difference between large and small. And it has to do with how much would the dollar grow. I'll take my dad's lifetime. My dad was born in 1926. And the question is, what would a dollar have grown in his lifetime to the time he was 92? He's 93 today, in these two different types of investments. In large company, $1 invested in the S&P would have grown to about $7,000. A really nice growth in my dad's lifetime invested in the S&P 500, which is a measure of the large companies. If you had taken the same dollar over the same time period and invested it in the small companies, then in the Matrix book, you see the answer. It would have grown to roughly 27,000. So much bigger growth between large and small. And then, that's kind of one of the ideas that I do expect that to some degree, because if that doesn't happen, why would anybody invest in the smaller companies? And then in the 80s, as you mentioned, there was this notion about all the large and all the small. And what came about is that the idea that when you look at owning a company, it's not just the fact that you own it, but how much do you pay to own it relative to a company fundamental. And the companies that have the stocks that have a low price for their fundamentals, whether it's earnings or book value, there are different metrics you can use. Those are called value stocks. And over time, they've outperformed the more expensive counterparts called growth. And if you know that small outperforms large historically, and then value beats growth, the one asset class, the one part of the market that ought to give you investors the biggest bang for the buck is one that has small and value. And once again, from the Matrix book, that number is about $72,000. So to me, that's the way that I think that this asset class investing has progressed. Look at the market and then be very very purposeful. And the more you want to emphasize small companies and value stocks, the more you give you a chance to earn higher expected returns. That's what it is. And what's the catch here? Because this well looks really good, but what's the catch? The catch is exactly what you mentioned earlier, Morgan. The catch is that when you look at this and you're saying, well, small outperforms, value outperforms, you might say, well, that's kind of what I expect to see. Well, it's not there every single day. These companies, smaller companies and value stocks, for sure, they carry more uncertainty. That's the reason you get paid more as an investor. And when you look at this, what you have to consider is not that small beats outperforms or value outperforms, but you want to consider the odds. That's what really matters in investing. I think really smart investors are not looking at investing as guarantees and certainty, because that's not what investing is about. I think investing in life in general is about managing odds, statistics, and probabilities. In fact, I used to not be very healthy in the way, maybe I smoked at some point and I wasn't very healthy, didn't work out much. And I switched. Now I'm a lot healthier. I don't smoke. I work out every once in a while. I pay attention to what I eat. But that doesn't guarantee me or anybody else a longer lasting, healthier life. All it does is just improves the odds. So that's why I think it's really important to look at the odds. So when you look at the odds, what you see is that over 1 year, these are very rough numbers, very rough numbers. Over 1 year, you look, for example, at small companies outperforming. What you see is that roughly about 57% of the time in any 1 year, you see that indeed, yes, small would outperform, and about 43% of the time, it won't. And 57%, you still have better odds in any 1 year that small outperform, but it's not a slam dunk. The question is, if you saw these odds, which part of the market would you like to emphasize? And if you give it more time, and if you go from 1 year to 5 years, for example, that improves. Now you have about 2/3 of the time that you see indeed small outperform, but even now you have 1/3 of the time that it's not there over 5 years. So that's why it becomes a matter of odds. That's why it's really important to understand that when you look at the odds, your odds are better with that small outperforms, and it will happen 2/3 of the time, but you have the 1/3 that's not going to be there. So you have to be careful to manage your expectations, because these are 5 years that you don't see that. It's just not common. I mean, it's more common to see, obviously, it's small, but it's not unprecedented. It happens about 1 in 3 periods, and that's what I think it's really important for investors to understand. You are buying into an investment philosophy, into a system that is much more data driven, is much more evidence driven, and that you are part of what this requires in order to work is discipline and managing expectations.
So, so that's great. And as an investor, you don't think that I should lose confidence if I happen to be recently in that maybe 1/3 block for the last 5 years. There's no data to suggest that these premiums have magically gone away, and it's just a matter of time.
It's no, absolutely. Because I
Okay.
mean, I would go beyond the data and look at the economic intuition. Has something changed with respect to the reason why I expect small companies to outperform? What is making me believe today that economically these large, well-established companies would have to pay a higher interest rate in a way because that's what you're doing. And when you put in the money in the market, you're basically getting a return. Why would I expect that the large, well-established companies would pay me more? It's almost like I'm 50 years old. If I walked into a bank today and I get a loan, if the same exact me walked in the same bank 25 years ago, why would I expect that the Apollo 25 years ago would pay a lower interest rate than the mature grown up Apollo? Well, obviously the track record does matter. So the cost of capital for these companies has to be lower. So even economically, absolutely, I believe that still continue to be the case, not just in the data.
Very good. So in essence, you're emphasizing something that we talked about, is that uncertainty creates a potential for more risk, and there's a risk reward. There's a connection between risk reward that never goes away. So that's, for example, one of the rationales behind a small company premium. One kind of tangent to this is maybe these premiums were a little less well known decades ago. Do you think the fact that maybe more uh, money managers are taking advantage of these premiums, that is there any evidence that they will be diminished
Right.
moving forward?
Right. Well, it's everybody has known about this for a long time, and in my opinion, that the knowledge of a premium itself is not necessarily diminishing it because everything is relative to something else. And I'll give you, just to start with just a quick analogy. Everybody has known there is what's called an equity premium, meaning that the stock market ought to pay investors a little bit more, quite a bit more than the bond market, because the bond market, you have an interest rate that you receive. There's a lot more certainty onto that because there's a contract in place. So if you think about the equity premium, which is the difference between what the stock market paid versus what you get in bonds, everybody has known about this for a very, very long time. Do you see that this what's called equity premium is now lower just because people know about it? Uh, in my opinion, we don't see that in the data, and intuitively, you don't expect that to happen. So even if the premium is known, it still will reflect the relative riskiness of companies. So it's all about the relativity of it. One has to be relative to the other. It's the same with these with these FICO scores. And I just recently was teaching a class to middle schoolers about just understanding a little bit of the basics of finance and money. And one of the things that I show them is if you look on the FICO score website, it shows you what would be an interest rate on an auto loan depending on your FICO score, which is your credit score. And what you see is that it's a relativity. Everybody knows that the consumers that have a lower FICO score, you're going to get paid more if you're willing to lend them the money. And so that's been known for a while, and you don't see everybody converging in that area. There's still a range because investors do have preferences around deploying their capital.
Yeah, so it's cost of capital. That's something we talk to our clients about a lot when they go out there
Absolutely.
in the marketplace as consumers. Well, good. In summary, for our listeners, that was the kind of macro big picture section of our discussion here. The first summary really is it's really hard uh, to marry what's happening and how the market moves relative to the economic news that apparently exists out there. So it's hard to make decisions on that. And I guess the second thing in summary was look at these premiums that many advisors look to and tilt towards in client portfolios. There's no evidence that they've magically gone away, and even though there may be some underperformance in recent periods. So now we're going to move to safety, our second subject area. And let's discuss some issues as they relate to safety. In January of 27, there was a really good paper that I read. Dr. Wei Dai published a research brief that stated, among other things, that broad diversification combined with long-term investing is critical to improving the reliability of investment outcomes. She goes on to say that the portfolio should be as broadly diversified as possible while staying consistent with efficiently pursuing the goal of the portfolio. So this was an aha moment for me when I read that brief. This idea of reliability of outcomes. And I think it relates to what you were saying earlier. It's this idea of statistical probabilities. I think many investors understand diversification as a strategy to help with volatility, but they haven't thought about it from a perspective of reliability of outcomes. Many
Yeah.
investors might say they are diversified, but they really don't have an idea to what extent they're diversified.
Yeah.
What are your thoughts on this, especially during times of volatility and uncertainty like we're seeing today?
Yeah, that was actually a great paper, it's really insightful what he was saying is that what you want is not, I mean, in a very simple term, you don't want to go from point A to point B in your financial life irrespective of risk. You want to find a way that you're not on the Goliath or Superman at Six Flags, which are roller coaster rides that I went with my daughter a year ago for her birthday. You want to find something that gets you to the same place, maybe more like a Legoland that's a little smoother. So the more you can diversify it, and I'll touch on maybe the biggest ones that you can diversify, I think the more you can smooth out this ride and the reliability, how likely it is that you get an outcome. So what are the different levels of diversification that you can hit? Well, it really, to me, it starts with probably the fundamental key decision in investing, which has to do with it has to do with investing in owning companies, which is, as I said, is the stock market. And if you look historically, it has grown at about 9-10% per year. But this is the basically the roller coaster. This is the big one. This is the ones at Six Flags that just make your stomach turn. But it has been a very rewarding ride. I mean, the price of admission is this choppiness. What you're seeing here is that even though that's the average from year to year, these returns can be all over the place. So don't expect an average every year. No, in fact, rarely do you see the average. It's quite often ups and downs relative to the average. But as I mentioned earlier from the Matrix book, it has been a rewarding ride because you do grow your money quite significantly. Now, to diversify, one thing you can do is put some money in small companies, put some money in value stocks, and that's a way to diversify away from the S&P 500, which is kind of what I'm showing here. The other way to diversify, which is incredibly important, is to not only buy ownership in companies because the fluctuating profits make the market fluctuate, but you can lend your money to corporations and governments, and that contract specifies an interest rate that you get, and at the end you receive your principal back, and those are bonds. And if you were to deal with, high quality issuers, and let's say the U.S. government, which in its entire history, it has never missed an interest payment or a principal repayment. So when you look at that, and let's say I'm going to give the U.S. government my money, 30 days later, I get it back plus interest. Those are called the 30-day treasury bills. It's a lot smoother ride. I mean, historically, when you look in the data, there's not a single calendar year when you would have seen a negative return. So it's a way to smooth out the ride by diversifying and not necessarily putting all your money into the stock market. But it comes at the cost of a return. So you don't earn 3 to 9, 10%. You earn something in the order of 3 to 4%. The good news is that you hit the bogey, which is inflation. Inflation is the one thing that is hugely important to consider, because if you just put the money in cash, you're going to lose value as inflation hits. So this one at least has earned a little bit above inflation. Now, just to see the trade-off, because it is a significant trade-off, the same dollar invested over the same time period in the safety of these 30-day U.S. Treasury bills over the same time frame, no difference in terms of the time frame, would have grown instead of 7,000 to a whopping $21.
Mhm.
So it's a very big difference, and that's why I think it is so important for everybody to have an advisor to sit down with Morgan and the team and figure out what is the right balance for my situation. When do I need the money? How much money do I need? Do I have a pension or not? Am I a business owner? What's my risk capacity? All these are hugely important considerations, along with many others. And then ultimately, they go into building a financial plan that takes account of all these personal circumstances. And based only on that financial plan, then an advisor can recommend, okay, for your situation, this should be the right balance between stocks and bonds. And everybody might have a different mix depending on your own situation. So to me, that is the most important decision in investing is just sitting down with an advisor, coming up with a financial plan, and figure out how much do I want to put into the stock market versus bonds. How much do you want to preserve capital versus grow it? And because these are very big differences in terms of what investors receive. So that's the first way to achieve what Dr. Wei was talking about in her paper. The second way is to realize that the U.S. is not the only place to invest. And in fact, one of the things that he can do is draw a map where instead of landmass, you plot the value of all companies that he can buy and sell around the world. And what you see is that in the US, when you add up Apple, McDonald's, Google, Wells Fargo, all the companies we know and love, there are about 3,000 of them in the US. And when you look at these 3,000 companies, they amount to about 54% of the value of all companies around the world in which you can buy ownership, which means there are about 9,000 plus other companies in 40 different countries that you can also consider as an opportunity to invest. And what's been interesting is there are decades when the US market is doing really well, and there are decades when international stocks are doing well. And that seesaw, in a way, is a way to increase the reliability of outcomes, because if they move in seesaw, then that's what's the negative. That's usually considered to be what's negative correlation, meaning that they don't move in lockstep in the same direction, but rather in opposite direction, and they balance each other out. And that's actually a good thing for a portfolio.
You
And the
know,
third, yes.
I love that chart that you just showed, because a lot of people, a lot of clients come to me and say, well, how do you build portfolios, and why wouldn't you want more in this country or less in some other country? And oftentimes they're looking at GDP, but what this chart actually does is it breaks down countries by market capitalization, which is different. And so so what you're saying is, don't just kind of buy at home with those companies that you're missing out on a lot of opportunities, and that could affect you uh, when it comes to reliability of outcomes and diversification.
Absolutely, and you have these 3,000 companies among the large and the small,
Hmm.
but think about this. I mean, in the U.S., we have right here in the Midwest, we have a GM and a Ford, and those are companies that we should absolutely worth consider buying. And then you have in Germany, you might have a BMW, and in Japan, you might have a Toyota. All I'm saying is that they're worth considering. Why not? You have an Apple here in Northern California, but you also have a Samsung in Korea. So there are opportunities everywhere. 7-Eleven. I just heard an ad for them, and it just kind of like said, we've been around for a long time serving communities. Absolutely true. It just turns out that right now they're owned by a company in Japan. So that's the idea, is that you want to participate globally and go a little bit beyond what you're comfortable with your back of the woods companies, and then the companies in your state or maybe in the US. And the more diversified global perspective you have, the more you can do exactly what you mentioned, increase the reliability, as long as things don't move in lockstep. If they move in lockstep, then probably they won't. But as long as they don't, that's what we see, then there's a benefit to global diversification.
Good. I'll let you move forward, but one point that I was always surprised when I saw that. oftentimes there were moments in the media where they said, China is going to take over the world, and you look at that, and it was only represented about 6% of the global the global market cap, which is pretty enlightening.
Yeah, because quite a lot of the Chinese companies are either not available for ownership by foreigners, or they're government owned, or just they're not. When you look at a U.S. investor, what that 6% represents the opportunity that exists for you rather than the economy. I mean, I'm not a great scholar of the Chinese economy, but just anecdotally, it does seem like the state and the government controls quite a bit of it. And why they have free markets, I just don't know to what degree all these are open and even transparent enough to pass the mustard of Western standards for disclosures and accounting. So
Well,
that's that's for another.
very good. So continuing on this theme of safety, recently, some of the media are laying out the case that many smaller companies with limited resources will not survive the COVID-19 crisis. And so we should make a point of focusing on investing in those large companies with deep pockets that will survive the crisis. And, the implication is that we don't want all those smaller companies that are not going to survive this crisis in our portfolio. And maybe utilizing index funds isn't the best way to be investing at this time. Is this true? Can we do anything to address this? And can you provide
Yeah.
some insight into this
Yeah,
notion?
so it's obviously it's intuitive. I mean,
It is.
absolutely, it does seem like, well, these companies are certainly not as well, and you hear on the paper, in the paper though, is just even as you read today that a lot of large companies as well are in trouble. It's not just small companies all of a sudden they are. I think that when we looked at the issue, first of all, the companies who are in a pretty precarious position, they have already been hammered by the market in terms of the price that you see. So you kind of say, well, maybe I should go pick some stocks. I don't think that's the right way to do it, because these companies have already been punished by the price dropping. On the other hand, you don't know which ones these companies will make it through, and how. And in fact, probably the way to get hurt is to concentrate into a handful of stocks you think are better than others. But we have looked at this issue of what happens to small companies when you do hit turbulent times, and how many of them actually go under. So what you see is that when you have a historical data set, and the question that he asking is, do small companies go underwater? And the way the technical term is called delisting, and delisting just simply reflects they're not listed on the stock exchange, either because they went bankrupt, something went wrong, they were the price went too low, whatever it is. And that kind of gives you a sign of what's going on with small companies. And what I can tell you, in the small companies, the historical average in terms of percentage of small companies being delisted is about 2.7%. That's over the long run. That's what you see. On an average per year, 2.7% of these companies that are small, they don't make it. So if you put in perspective, if you have 2,000 small companies in the U.S., and then about 2.7% of them don't make it, it's roughly 50 or 60 companies or so in the neighborhood that don't make it in a particular year, and that
Okay, can we
is
can we
on.
pause for a second? Just to clarify, you're defining small companies as the lowest 10th percentile or 6th percentile. What
I
is that?
appreciate you. I appreciate you kind of bring that up. So because I'm kind of being presumptuous here. So if
No,
you
that's
bring
good.
up the market, there are different ways in which investors define what is large cap and what is small cap. And
Hmm.
one of the definitions that is out there in the industry is you take the first 1,000 companies in terms of their size, and size is the price per share multiplied with the number of shares outstanding, and that's called market capitalization. How valuable is the company? And you take the 1,000 largest, and that becomes large, and then the next 2,000 they become small. That's one way we do it. That's one way to do it. The other one is to consider, instead of that, is that the companies that, when you start adding them from the bottom, account for the bottom 10% of all the stocks in the market. So when you add up their value together, amounts to 10% of the value. Then you say, well, the largest of these becomes the largest in the small cap universe, and then everything else beyond it is large. So that leaves that 90% of the value of companies are in large. The two definitions are not vastly different. They're roughly similar. What matters is implementation. That's the reason. But what do you think of the bottom 2,000 companies or the bottom 10%? It's roughly the same in terms of coverage. That's what small companies are. And so when you look at these smaller companies, and it's capitalization about $3-5 billion, so they're not tiny companies. That's the largest in that universe. You see that about 2.7% on average any given year, they go under. And as a reference point for large companies, it's about, I think, 0.4%. So it's certainly more for small companies than it is for large. Now, what's interesting is that is the historical average. When you look in periods when the economy is hitting a rough patch, and we had something in 73, 74, and we had some in the early 90s. We had obviously the tech crunch, and then the great financial crisis. What you see is that there is a spike in the rate at which these small companies get delisted, and historically the worst that we've seen, I think, is in the neighborhood in any given year of about 6-7%. I don't remember seeing an 8%, but let's say it's 6-7% of these companies, which means that out of 2,000 companies, you might have something in the order of, you have 150 companies, so let's say 200 companies out of 2,000 that are going under. But the vast majority of them, they're going through even, and these are the extremes, by the way. These are the absolute extremes that we see. It's not that the majority of them are going under. A subset is going under, and that's fine. And so will a subset in large companies, because my guess is that is that when you plot the same thing, you will find that small companies also might go under at a higher rate. So that is the that's sort of like the way that I think about it, is that yes, there will be small companies that will go under without a doubt. But the beauty of being diversified through these dimensional funds is that we're trying to get coverage, and we're looking to get exposure to the entire asset class. So you have pretty much all the companies in that asset class on a consistent basis, and even them, some might not go through. The majority do emerge after the storm.
This is almost ways. And this is almost really a great data point showing that, look, there is in fact more risk in small companies. Thus, the more risk, the more future potential returns, right?
Exactly right. And that's exactly why I expect to get paid more, have a higher expected return in small than in large, because there are periods like this when in a downturn, these small companies don't do as well. I think there are different ways also to think about it, is that if I'm telling you that there's a 7% death rate, well, that sounds different than 93% survival rate.
Right.
So it's basically, it's the flip side of the same coin. It's just that it sounds worse when you say companies are going under versus like, hey, 93% of the companies are continue to chug along and be just fine afterwards.
Great. Well, that's a great data set. I really appreciate that. I had not seen these particular numbers. And I guess it goes to the point of emphasizing the returns that people see that the markets have produced includes all of the good companies and all of the bad companies, and just focus on that. And we have no evidence to show that index funds aren't doing their job in times of crisis.
I would actually argue it's exactly the opposite.
Okay.
There's a paper that's one of my favorite papers. It's called Migration, and anybody can Google it. It's written by Professor Eugene Fama at Chicago and Ken French at Dartmouth. And what that paper did, which is an academic paper published a while ago, it's a fantastic paper because it looks and says, we see there's a premium between small companies and large. What are the actual companies that generate this premium? Can we get a sense of what these are? And if I remember correctly, what the paper suggested is that this entire premium, the difference that we saw in the growth of small versus large, is generated by a relatively small subset. I think it was 10-15% of really high flyers, let's say among small companies.
Mm-hmm.
And it's this relatively small subset that are the high flyers that generate the extra returns. And if you are trying to select stocks, you're much more likely to miss them because this is a very small subset of 10-15%. It's not that half the companies are flying high and generating. It's a relatively small subset. So you need to own the entire asset class, because if you don't, you are at great risk of not capturing these premiums because you don't have these high flyers. And of course, we've looked at it, and the professors have looked at it. Can you identify these and just kind of emphasize them more? There's no way to do that. What you see is just that ultimately you need to capture the entire asset class. And that's what a comprehensive asset class fund would do, whether it's an index or dimensional.
Gotcha. I think I was going to pull up a slide, but I will not do that. And we'll keep our discussion and talk technology a little simple. But I have seen that the point is, and I talk to clients about this, and we all do here at WorthPointe, is you've got to have all those good companies in your portfolio. And this idea of probabilities, what's the best way to do that? And the research indicates that buying the whole basket, you're guaranteed. We don't like to say guaranteed, but if you buy the whole basket, you're
Right.
most likely going to have most of those companies in your portfolio, while others may not. Very good. So let's wrap up our conversation on safety before we move into opportunity. And thanks for that explanation, Apollo. Our philosophy as a firm is really generally to pursue returns through equities and pursue safety through bonds. Many investors think that a bond equals safety, and are surprised when their bonds, maybe they're more volatile than they expected them to be. I think WorthPointe, on the other hand, we found that not all bonds are created equally, and there are, in fact, some key metrics we can look at to help us mitigate the risk towards safety within a bond allocation in our portfolio. Namely, we look at a lot of the research that I'm sure you're familiar with, is global diversification, taking advantage of different yield curves around the world, generally shorter duration, or maybe the better way to say it is duration appropriately relative to the current yield curve, and higher investment quality. So those 3 points are what we look at. Why and how do the following risk strategies for selecting bonds help reduce risk? I think the reason I'm bringing this up, I think there's a lot of folks out there who think, God, bonds aren't good right now, or maybe they are, and they're a little confused. And with the yield curve doing it what it's been doing lately, maybe we can just kind of solidify these concepts in our investors' minds.
Well, I think it's a very good point that he raised. You can always get a higher interest rate on bond. There's no doubt in my mind. You can always find, if you're not happy with the 1% that the U.S. government, the 10-year bonds are giving you, absolutely you can go find one that pays you 5, 10, even 15% for the same time period. You just have to understand that comes at a much higher risk that the issuer might breach the contract. So there is a catch there. And the point that he made, these bonds, even if you go and you say, I'm going to go from the short-term high quality, which are the U.S. government bonds for short-term, and let's say I'm going to go into long-term corporate. If you look over the long run, what you see is that the return improves. Instead of 3-4%, you make something about 6% per year. And yet, even at 6% per year, the growth of the same dollar, again, coming from that matrix book, the growth of the same dollar, even in long-term corporate bonds that carry certainly more risk than the short-term government, they tend to go, it goes to about $225 in growth from a dollar, vastly different than 7,000. So even if you go to these bonds, it just seems that you get more bang for the buck to saying my growth comes from stocks. And I think that's exactly what you're doing, what Morgan is saying, which is it makes complete sense to me. Even if you go to riskier bonds, you're not necessarily going to get paid enough to justify the additional risk. And there's one more thing. I mean, and that's something that you're going to talk is if you're looking for income in retirement, that's one way to look at it. But there, certainly other ways, and Morgan can tell you more about, if you do need that steady income, I'm not sure that the high risk bonds are the best way to get it.
Good. Yeah, we do definitely talk to clients about total return
Exactly.
when investing for retirement and for trusts. So good. That was some good feedback on this. Really, the three fundamentals we look at, but to make it more simple, the idea of taking your risk in equities and don't take that risk in bonds, and there was a way to diversify and make that bond allocation relatively safer by those three factors. Um, there's no indication that those strategies haven't broken down during this fundamental crisis. And when I say strategies, I'm talking about global diversification for the bonds, looking at yield curve for duration on the bonds, and credit quality. Okay. All right. So let's transition to the conversation on opportunity. Even though there's a lot of bad news out there, my conversations with clients have shown that really there's a lot of folks out there that still understand that these situations create opportunities as well. Having said that, when the stock market falls, many investors focus on today's value, which is understandable, but it's easy to lose sight of long-term goals in investing. So when the markets go down, how does this affect expected future returns of stocks and the opportunity to be rewarded? I think this is something worth exploring a little more.
Right. No, and it goes back to that fundamental principle that it's all about the price. So whenever the prices come down, then you have to kind of look and say, it just even intuitively, whenever the prices go down, that is an opportunity to perhaps get something at is a lower price, a better valuation than when the prices were higher. Particularly when you think about the long-term investing that is involved in owning companies. And the way that I think about this is that Warren Buffett has always made that point that be fearful when others are greedy and greedy when others are fearful. Buy when there's blood on the streets. And basically, what he's saying is that when something like this happens, don't get carried away with the emotional side of investing, which kind of says flee safety, because that's what we are like as human beings. And when there were with an animal chasing us, well, that emotion would make us run, and fleeing saved our lives. And that those emotions are also part of investors today. And I think that having an advisor to kind of say, is that in your best interest or not? And quite often what you find is that the emotional side of investing, the behavioral side, who's saying, well, when something goes down, that looks dangerous, I don't like it, I might need to sell it. Where the advisor is kind of saying, wait, investing should be about buying low and selling high. So what it means is that if something drops, that's an opportunity. And the question is, how do you capture it? And I think one of the more interesting things that advisors do, and it's quite often not, I mean, it's discussed, but I found it particularly relevant these days, is that when the market drops, and there's a certain balance between stocks and bonds, and there's a certain percentage in stocks and certain bonds, and then when the market drops, one of the things that advisors do is they have a plan that was put in place in advance. It's predetermined. What do we do when that happens? In other words, I live in Los Angeles, and I know at some point there will be an earthquake. And what I've tried to do is put a plan in place that I know what to do when that happens. I don't have to make decisions on the fly, particularly when emotions are high. And it's exactly the same with the advisors. When you have that predetermined plan, you know that when the stock market drops, and we didn't know when, but we knew at some point it will drop, what do we do? And it turns out that the best course of action is to pay attention and very carefully decide, is this a good time for me to buy more stocks, but not necessarily as a way to make a forecast that they're going to shoot the roof, but just simply, I need to get my portfolio back into the right balance. And that, in fact, is called rebalancing. And rebalancing a portfolio is a fundamental premise of modern investing, which is when something goes down, you want to own back some of it so it gets the right proportion. But rebalancing has also helped investors on the way here, because for 11 years we had sort of a bull market, and if you had not done rebalancing on the way up, in other words, trim the gains as stocks go up to maintain the balance, the portfolio would have been dominated by stocks, and they would have created too much of an exposure, too much risk in the allocation. So those are two sides of the same coin, and I think that it is hugely important to pay attention to this, and it has to be done carefully. And advisors pay attention all the time. Is this the right time to rebalance? And quite often, the best decision is not to rebalance, but there are times when you ought to do it, and particularly when the markets are moving up and down quite more than normal.
Interesting. So in fact, when the market goes down, the light at the end of the tunnel can actually shine brighter.
Yep.
And it's interesting you brought up rebalancing. We just posted an article on rebalancing in times of high volatility. And what we like to say is that there's both an art and a science behind that.
Absolutely.
All right, let's move on to the next question. So we know intuitively that no one can predict the future, but investors often still try and grasp onto the idea that a person or a system can do just that, predict the future. Which stock to buy, when to get into and out of the market. Some indeed have shown on occasion to be successful. Intertwined with this is the concept of distinguishing luck from skill. So can you help us sort out what the real issues are in trying to time the market or acting on news to try and reactively craft an investment decision?
Yeah. So there are two questions, if I have them. One has to do with selecting the right stocks, and the other one has to do with moving in out of the market, which is what market timing is. So let me start with
fair enough.
Should we how do you think about maybe kind of moving out of the are there particular sectors better positioned, particular stocks better positioned to take advantage of the current situation? And in that system, the idea is something like this. If this squares, again, the stock market, some folks define success as cherry picking what they think are the right sectors or the right companies in this environment. The thing with this, there are two things with this. The first one is that, surprise, surprise, you're not the only one. In fact, right now, just as a statistic, there are more professionally managed mutual funds in the US than actual stocks trading on the market. So it is extremely competitive out there. And what happens is that anytime you find a company or a sector that is better positioned, people crowd it in. It's like you go on eBay when there's something that really looks good and you have enough buyers, well, the price will be moved up to the point where might not be such a good deal. And that's what's happening right now, is that whatever is obvious and whatever people are saying, aha, this is gonna be the next thing, well, the price gets moved up. And even the technology that we're using today, I mean, just look at the price and what happened to it. It might have been a good deal a while ago. Right now, what you're paying might or might not be such a good deal because the price has moved up so much and it's become expensive. That's the first thing. The second thing that I would caution people is that in order for you to take advantage of this system, in order for you to really make money out of this, what you need to do is concentrate. You have to concentrate, because concentration in investments is the way that you hit it big, and that's
And
how
when you
you.
say concentrate, you're not saying, okay, I got to think hard on this. It's you're talking about
That's a good
concentrated
point.
positions.
Concentration.
You can do
You put
both if you
a
want
lot of your
to.
money. You put a lot of your money into these bets. You put a lot of your money into one. That's, thank you for being. It's not concentrate like focus, but it's you need to concentrate a lot of your assets. Put a lot of your money into an investment, because if you don't do this, then the alternative is that you have these investments, but if you have them alongside many others, not any one investment would ever significantly impact your wealth. And that's the system that I personally appreciated, because in this system where when you try to select and concentrate and place big bets, what you're doing is you have the opportunity to make it big if you hit the right bet. The problem is that, as I've seen it over and over again, it's also possible that putting so much money into a business or a sector can also lead to devastation. And to me, if you are an investor today, you could speculate and shoot for the fences and see if this works out, and you can make a lot of money or lose a lot of money. I think the value proposition that Dimensional, and I think I'm speaking for Morgan as well, is not, let's shoot the lights out, let's start place bets with your money, but rather we want to have a system where not any one investment would ever significantly impact your wealth. So in this scheme, let's say in a global portfolio, the global equity portfolio, there would be over 12,000 plus companies that you own in 40 different stock markets. And in that respect, what you're really doing is going back to what Morgan said. It's about the reliability of outcome, shrinking the range of what can happen with your money. Instead of your money can go either here or here, it's narrower. And why? Because if you own 12,000 companies, is it likely that all of them would go under at exactly the same time, so you lose all your money into the stock market? And the answer is quite unlikely. And if that's the case, we probably have big problems, more like Mad Max time, a lot more concern than our investment portfolio. But on the other hand, you also have to realize that there won't be any one investment that's going to shoot the lights out.
But
Simply
it's
the value proposition is not how do we change somebody's wealth status quickly. It's rather how do you grow the assets in a more responsible way, and you're going to get there. But instead of getting from point A to point B with all kinds of craziness, you're trying to mitigate and reduce the range of the outcomes with somebody's money.
it's funny, as you were describing this, the left hand concentrated position example sounds to me a little like Las Vegas, like
It
going to
is.
Vegas, and you get big winners and big losers, and the big winners, they're out there very visible and talking and buying drinks for everybody, and the losers kind of sneak out the back door.
Exactly right. And when you hit a winner, you feel like, oh, it's my skill. When it's a loser, well, it's just bad luck. When in fact, it's not really under your control. I mean,
Yeah,
you control this, and I think that to that example, if you are embracing the market, if you are saying, I don't want to place bets, I want to be the casino house and put the odds in my favor. To me, the way to do it is not to try to pick some stocks, but really buy globally, buy the entire global productive capacity, and play enough hands. In other words, stay in the game long enough where the odds are tilted in your favor.
right. And I always tell investors, hey, if you want to go to Vegas, go to Vegas. Just
Right.
realize what your potential outcomes are. And if those potential outcomes from, losing almost, if not everything, to, you know, getting a big windfall. If both of those outcomes don't really suit your goals with regard to perhaps retirement money and money you can't afford to lose, then maybe think twice about investing in a concentrated position.
Or if you have like what I call like sandbox money. So it's basically
Mm-hmm.
say, I do want to try it. I do like the investing. I do like the appeal of making moves and being in the market. And I have very close family members who do that. And it's absolutely fine because to them, it's stimulating the brain muscle. It's something intriguing and interesting and they want to just learn it. But the bulk of their family assets are invested responsibly with an advisor. And they have a part that they're just basically keeps them busy, particularly in these days where everybody's stuck at home. But realizing that that's if you're not in there, it's not a competitive advantage. It just be careful, tread. I mean, and it just I've talked to so many people lately who got this lesson because they got into oil and they thought oil, oh geez, like all these contracts, you can make so much money and the
Yeah.
oil is cheap. This is the best place to be and best time to be an investor in oil. And then a few weeks ago, you saw the negative price and so many people lost their shirts. There are a lot of retail investors who got into this. And in fact, I was reading that the inflows are huge in the largest oil ETF just before it just completely went bonkers.
Son of
So,
God. Well, I'm still waiting for that time where I go to the gas station and they pay me to fill up my gas tank.
oh,
So great. That's I really appreciate that feedback. Wrapping up this idea of opportunities out there. You're speaking with a lot of folks out there. And what challenges do you generally see for investors trying to navigate all of this that's going on by themselves? And you know, it just seems like there's a lot going on now with, you know, kids at home, family life, career, and then the markets and the economy with a lot of uncertainty. Um, how well do people fare trying to do this on their own?
I think there are two issues when I see people trying to do this on their own. The first one is that there is a behavioral consideration to this, I mean, there are three things basically. If I think about it, there are three things when people try to do it at home. The first one is a behavioral consideration that people sometimes don't have the easiest time dealing with their own money, and quite often the decisions that they make are emotional. So they're not necessarily based on quite a lot of reason, but it's emotional because you hear from somebody or you feel like this is the right time. So you see, I don't know, I don't think it's the right time in my, but it's really quite a lot of behavioral that we've seen with people in terms of deploying their assets. And it's also emotionally stressful when you deal with your own money because if you make a mistake, and I personally, my father-in-law at some point, you know, apparently didn't do very well in some investments and that he controlled, and he's been really upset for years and years and years. And I don't know that that's ever going to go away. I mean, that regret, like what I do with my own money, it's a tough nut to crack. The second part of it is that the competence that advisors have and the experience and the professional credentials and the expertise that they built over the years, it's really not easy to match by somebody whose core competency is not investments. It's like me saying that I picked up a book on, you know, electrical engineering and I can popular mechanics or something, and I'll go and I'll say, well, I want to compete with a guy who's been doing this or a gal who's been doing this for 20, 30 years. It's very different. There's a level of expertise and knowledge that you gain by being part of that. And if you just, you know, taking the time and do it and you absolutely dive into it, that might be something worth considering. I just find that it's really hard to replicate the experience, the competence that advisors have. And the third piece that I found with do-it-yourselfers is that quite often it is one person dealing with finances and everybody else in the household is a little bit on the outside. And I find it's quite troubling because, knock on wood, something happens to that person. It's really hard for the family at that point to figure out where's the money, how do we deal with this, and then trying to find some help in those times of crisis. It's actually quite bad because you could be prey to a schmuck. So it's a lot better if you have an advisor who can not only look at one person's financial goals, but it's something that goes across the spouse, goes with the kids, so you can pass on not only monetary and wealth in terms of money, but also family values. And I think it's a really big part, because we don't live in an individual society. We live in a family society, and quite often I have been surprised to see how often the do-it-yourselfers are just like one person, and the spouse is completely on the outside. And I used to be like that years ago, and I realized that's not right, because my spouse needs to be involved, needs to be part of these decisions, and know about the financial matters of the family.
Apollo, you have laid out a lot of pearls onto our virtual desk here, and we very much appreciate your time. And we wish you safety moving forward. And what I'm going to do is share my screen as we wrap this up. So again, Apollo, thank you very much. Appreciate your time. This was a lot of great information that we covered. For those of you listening, feel free to contact your WorthPointe personal financial advisor at any time if you have any questions or thoughts on any of the material that we discussed, or reach out to us at the number, email, or find us at the website below. Thank you and take care.